Hi guys, welcome back to my YouTube channel. Today we are going to be talking about risk versus return. We are going to be understanding the definition of risk, how it relates to return, and how it pertains to your financial vehicles, which you will be choosing for your financial independence. Right. So in my previous video, I made mention of several financial vehicles that you can use as a way to reach your financial independence. But you have to understand that each of those vehicles have some risk involved in it, right? So we're going to be looking at some more definitions on how you can take advantage of risk and increase your return, because a lot of people are risk adverse, meaning that they don't want to take risk. They want to go to the most stable financial vehicle and not take risk, right? So the purpose of this video is to help you take educated risk, right? Calculated risk, because through that educated and calculated risk, you could stack up luck, or you could stack up favor, or you could stack up what have you, to make sure that things are working in your favor relating to your financial independence. So let's dive deep into this video. I'm excited that you are here. Use this opportunity to like my video, subscribe to this channel, and let's get down to it. So understanding risk versus return. So we have to understand the relationship between risk and return, which is crucial in the world of finance and also in the world of investments. Understanding the relationship between risk and return is crucial in the world of finance and investments. The basic principle is that the potential return on an investment is generally correlated with the risk associated with it, right? So before we continue, let's define the terms and properly understand what they mean, so that we all can be at the same level of understanding. So what is a risk, right? A risk refers to the uncertainty or the variability of returns from an investment. It is the possibility that the actual returns will deviate from what is expected. So let's use this example to understand it deep. You invested $1,000 into Apple share and you were expecting a 5% return or $50, but the return comes in at higher at 6% or $60, or lower at 4% or $40. So that's risk. What is a return? A return is the gain or the loss made on an investment relative to the amount invested. So it's expressed as a percentage of the initial investment. So let's look at the types of return that you will get. There's one called capital gain. Capital gain is the profit from the increase in the value of an investment. So you invested $1,000 in a share, and tomorrow the share was worth $150, right? So you've made a capital gain of $50. So dividend income. What is a dividend income? This is the income received from dividends paid by a share or by a stock or by other investments. In real estate, we call it cash on cash return. So interest income, the income earned from the interest payments on bonds and other interest bearing securities. That's what interest income is. So we have to look at another term called the risk return trade-off. What is the risk return trade-off? The risk return trade-off is the principle that the potential return rises with the increase in risk. So investors must decide how much risk they are willing to take, except in exchange for a potential return on their investments. In other words, there is a direct relationship between risk and return, which means more risk you take, the more returns you are going to make. Think about it this way. The biggest risk takers in this world are the richest people on earth today. Think about Mark Zuckerberg, think about Jeff Bezos. These are big risk takers, right? They were able to take risk, and then the market is rewarding them for the risk that they took, right? So there is a potential, there is a relationship between risk and return. The more risk you take, the more returns you will make, or the more money you will lose, right? So it goes both ways. So be mindful that when you are super aggressive in your goals, there is potential that you might be super successful, or things might go southwards, So just bear that in mind, and think about that as you choose your financial vehicles. So another term that I want us to take a look at is the risk tolerance. The risk tolerance is the level of risk that an investor is willing and able to accept. So it depends on factors such as what are your financial goals, what are the time horizon, and individual preferences. So that's a very important term to remember. So another definition I want us to go through is the time investment horizon. So what is that? The time horizon is the length of time an investor expects to hold an investment. So assuming you have a real estate property you want to hold for a period of 5 years, right? So that's your time horizon. So generally, longer investment horizon may allow for higher tolerance. So let's use a story to illustrate the risk-return trade-off. So let's imagine a scenario where we have two friends, right? We have Alex and then we have Morgan. So both of them are considering different investment opportunities, right? So on this hand, Alex is more careful. He's risk-averse investor. He has diligently saved his money, and now he's looking for safe investment options. After researching, Alex discovers a government bond that offers a fixed interest rate over a specified period of time. This bond is considered low risk because it is backed by the government, and the interest rate payments are guaranteed. So you are guaranteed $10 every month, So Alex decides to invest a significant portion of his savings in this bond. Now, let's look at the other lady called Morgan. Morgan, on the other hand, is more adventurous and seeks higher return. She came across a startup that is gaining attention for its innovative products. So this startup is inviting investors to participate in its early funding rounds. So while Morgan is excited about the potential for high returns, she is also aware that investing in startups carries a higher risk compared to the government bonds. So the success of the investment depends on the startup's ability to grow and become profitable. Think about these two dynamics. So as time goes on, the two friends experiences different outcomes. So number one, Alex's low-risk investment, the government bonds provide stability, and it provides consistent, interest payments as promised. The government is now paying Alex, $50 as they promised. However, the returns are relatively modest. Alex's investment is secure, but the trade-off is a lower potential for significant financial growth. Now, on the other hand, let's look at Morgan. So Morgan's high-risk investment, the startup, as expected, was riskier venture, goes through the ups and downs. There were moments of excitement when the company was doing great and they were achieving great milestones. but there were also challenges, right? So the stock price can be volatile. They can move up and down. So Morgan understands that the investment is riskier compared to the government bonds, and there is a chance that she could lose some or even all her investments. However, if the startup succeeds, the returns could be substantial. So this is the key takeaway from these two stories, right? These two investors have different risk tolerance, and their investment choices reflect their comfort with risk. So why some prefer government, security, low risk investments, others may be willing to take higher risk in pursuit of greater returns. The important aspect of managing risk is aligning investment choices with individual goals and then your risk tolerance. So what is the moral of this story? As you are able to look into what financial vehicles you are going to choose to help you with your journey to your financial independence, you have to decide what is your risk tolerance. How much risk are you willing to tolerate? How much risk are you comfortable with taking? As a cybersecurity engineer, I work for different companies. I work for my company and they pay me. I use that money judiciously. I don't use the money that I earn, which is what I consider my capital. I don't use that money and invest in riskier investments. I don't use the money that I earn from my W-2 income, from my work, and invest it in riskier investments. I do not do that. I first of all figure out what vehicle I can put the money that has been tested over time and that has been tried over time, right? And that's why I choose real estate as my primary vehicle. Basically, I have two. I have IUL's life insurance, which is universal index universal life, and then I use real estate. So these are my primary two vehicles that I use, right? Because they give me great returns, and at the same time I am guaranteed that at some point in time I'm going to have a return of my capital, right? So if I invest $10,000 in a life insurance cash value, I'm sure that I can go back and withdraw that 10,000 or use the 10,000 as I see fit, right? I can invest that 10,000 in real estate. I know that my money is safe. So real estate is a great place to park your money, right? So that's what you have to define for yourself, right? So what is the risk versus return? What would that look in your finances? What would that look for you in your finances? How would that look? How would you try to paint that? So people who are more aggressive in their finances, they invest in riskier investments. They look for investment that can give them potential returns. I don't do crypto, I don't do all of those, but those can give you higher returns, like I've heard and also researched, right? So there are also vehicles out there that can give you quicker returns, but just like they can give you quicker returns, you can also lose money from using that. So think about the risk versus return. Think about what is your risk tolerance? How much risk are you willing to tolerate? So as you look into some financial vehicles that you would like to invest in, think about what is my risk appetite? You know, how much risk am I willing to entertain? How much risk am I willing to take? Right? So let's look at a real estate investment, for instance, right? So apartment investing, the hold period for an apartment investing might be from 3 to 5 years, right? So that's my own time horizon. I'm looking at within 3 to 5 years, I'm looking at adding X amount of dollars to my capital, right? And then you have to think about the risk return trade-off, right? So how much return am I looking at getting, right? So within that 3 to 5 years, I'm looking at doubling the capital that I invest in real estate. So these are the things that you have to sit down. Like I said, we can only recommend, we can only suggest, but Your escape velocity framework has to be defined by you. You have to sit down and think, what type of investor am I going to be? And that's the question I want to leave with you today. What type of investor are you going to be? Are you going to be more aggressive, more conservative, or not invest at all? That is your own predilection. And you have to choose who you want to be and where you want to be. And what does your financial independence mean to you? Thank you for watching this video. I'm sure you must have been enlightened. Like, subscribe, and comment on this video so I can make more awesome videos for you guys. Thank you. Bye.